22.6% in a single trading day. The Dow Jones, the heart of American finance, gone. Not over weeks, not over months. In 6.5 hours, $500 billion of wealth. In today's money, vaporized. Panic so absolute, they stopped the ticker tape. They locked the doors. They considered shutting the markets down forever. The VIX, the so-called fear gauge, spiked to 82, a number so insane it broke the mathematical models. Treasury bonds, the safe asset, froze. No buyers. For the first time in history, you could not sell a US government bond. The system didn't just tremble, it went catatonic. Now, look at your screen, look at the price action you saw today, the wild swings, the headlines scrambling for a reason, inflation jitters, Fed fears, geopolitical tension. They are telling you a story, a comforting lie. Because what happened in the markets today was not about news, it was not about data, it was not about fear or greed. It was a structural failure, a predetermined, mechanical and inevitable seizure in the circulatory system of global capital, and the catalyst was something so mundane, so bureaucratic, that almost no retail trader is even aware it exists. It happened in the dark, in the back office, on a balance sheet ledger. It was a $2.3 trillion derivatives contract tied to the Japanese yen, expiring at precisely 10 a.m. Tokyo time, that forced a cascade of collateral calls through 6 major European banks, which triggered an automated liquidation sequence in a specific, over-leveraged corner of the S&P 500 futures market, which then tripped every single volatility control algorithm on Wall Street simultaneously. You did not see a market move today. You saw a machine break. And the terrifying, undeniable truth is this: the conditions that allowed that machine to break are now permanent. They are not cyclical. They are not fleeting. They are structural, baked into the very code of modern finance. And what transpired today was not an anomaly. It was a preview, a dry run, the first tremor before the seismic event. I can prove this to you with 3 numbers, 3 pieces of mathematical architecture that Wall Street desperately hopes you will never connect. Number 1, global derivative notional value, as of last Friday's close, $611 trillion. Let that number settle. $601,000. This is not money that exists. It is a web of promises, of bets on bets, of insurance policies written against other insurance policies. It is a phantom mountain of leverage resting on a pinpoint of real economic activity. This number is 30% higher than it was in 2008. The system is not safer. It is exponentially more fragile. Number 2, the daily liquidity gap. This is the critical metric. This measures, in real time, the difference between the gross value of assets that need to be bought or sold and the actual available cash in the system to facilitate those trades. Think of it as the oxygen level in a sealed room. In a healthy market, this gap is wide. There is ample oxygen, ample cash to meet transactions. As of this morning's pre-market, for the entire US equity and treasury complex, that gap had narrowed to $89 billion. $89 billion to lubricate a $100 trillion market. This is the thinnest, the most anorexic, the most brittle this buffer has been since the morning of October 19, 1987. The oxygen was already being depleted before the opening bell even rang. Number 3, the concentration multiplier. In 1987, the top 5 market makers controlled roughly 20% of order flow. Today, that number is not 20, it is not 50. It is 73%. 73% of all equity trades flow through the hands of fewer than 10 firms. Their algorithms are not competitors. They are cousins, written with similar logic, fed similar data, operating under similar risk parameters. When one flees, they all flee. When one buys, they all buy. This is not a market of thousands of independent actors. This is a monolithic organism with a single centralized nervous system. And today, at 11:47 a.m. Eastern Time, that nervous system received a shock it was not programmed to withstand. Let me walk you through the anatomy of today's cardiac arrest. Forget the headlines. Forget the news. Follow the sequence of mechanical failures. The trigger was not in New York. It was in Tokyo. The Bank of Japan, after years of negative interest rates, is trapped. They are attempting a policy normalization so delicate, so fraught with peril, that it makes the Fed's job look simple. They are trying to gently raise yields to defend their collapsing currency without imploding their own government bond market, which is the most indebted in human history. Last night they intervened. Not with words, with action. They conducted an unscheduled, unlimited bond buying operation to cap a specific yield. This was a declaration of weakness, not strength. It was a signal to every global macro fund. The BOJ is losing control. This matters because of the yen carry trade. For over a decade, institutions have borrowed Japanese yen at near 0% interest, converted it to dollars, and bought higher-yielding U.S. assets, treasuries, tech stocks, corporate bonds. This trade is estimated at over $1.5 trillion. It is one of the foundational supports of the entire global asset price structure. When the yen strengthens, when the cost of repaying that borrowed yen rises, this trade must unwind. It is not discretionary. It is automatic. Borrow yen, sell U.S. asset, repay loan. This is what began in the Asian session, but here is where the modern system magnifies the shock. These positions are not held in simple forms. They are wrapped, layered, and rehypothecated within total return swaps and cross-currency basis swaps. These are the derivatives. The $6 and $11 trillion mountain. A move in the yen does not just cause a fund to sell a stock, it triggers a margin call on the derivative contract that represents leveraged exposure to that stock. This margin call is not a request. It is a digital demand for cash, collateral to be posted within hours. This demand for cash hit the European banking system at 3 South AM their time. These banks, you know their names, are already straining under the weight of their own problems. Commercial real estate losses, soaring deposit costs, they are liquidity constrained. A sudden collective demand for billions in USD collateral is a crisis. To meet it, they do not sell their own long-term holdings. They tap the fastest, most liquid source of dollars they have, the U.S. Treasury repurchase agreement market, the repo market. At 8:30 a.m. Eastern, the rate on overnight Treasury repo, the cost to borrow cash against the safest collateral in the world, spiked from 5.33% to 7.15% in 3 minutes. This was the canary screaming in the coal mine. This was the first public signal that dollar liquidity in the core plumbing was vanishing. The big banks were hoarding cash to meet their own survival needs. This spike in the repo rate was the second trigger. It was read by every institutional trading desk not as a curiosity, but as a red alert siren. It meant the lubrication for the entire day's trading was failing. The immediate reaction was a flight to nothing. There was no safe asset. Treasuries were already under pressure from the yen unwind. So the only move was to sell what you could to raise cash. Equities. But not just any equities. The most liquid ones. The big tech names. The megacaps that make up the S&P 500 and the Nasdaq. This selling hit the market at the open. It was absorbed barely by the remaining market makers. But their algorithms are governed by one primary commandment: manage volatility. Their models are designed to provide liquidity when markets are calm and retract it instantly when volatility rises above a specific threshold. That threshold was crossed at 10:15 a.m. The crossing of this line was the third and final trigger. It switched the market's regime from normal to stress. And in the stress regime, the algorithms change their mission. Their goal is no longer to facilitate orderly trade. Their goal is to protect the capital of their parent institution. They widen their bid-ask spreads to prohibitive levels. They reduce the size they are willing to trade. They begin to sell their own inventory to de-risk. This is the moment the market broke. This is the moment liquidity vanished. With the market makers stepping back, the sell orders from the yen unwind and the cash hoarding banks hit a void. There were no buyers. Price, in the absence of liquidity, becomes a random number generator. It gaps down violently to find the next willing buyer, who is now miles away. This is what caused the vertical, terrifying drop you saw on your chart. It was not a wave of selling. It was the floor disappearing. This is the new pattern. This is the script for every major dislocation from now until the system is fundamentally reformed, which will not happen voluntarily. The trigger will vary: a Japanese bond, a European bank, a UK pension fund, a Swiss franc move. The pathway will always be the same. A hidden leverage fault line ruptures, transmits a shock to the global dollar funding markets, exposes a liquidity shortfall, and triggers the algorithmic withdrawal of market making. The flash crash is no longer a bug. It is a feature. It is the system's default stress response. Now let us step back. Let us understand why this is now permanent. It is a confluence of three unchangeable facts. First, the end of the market-making function. The role of the human specialist, the floor trader who was obligated to provide a bid and offer even in a storm, is extinct. That human has been replaced by code. And code has no obligation, no discretion, no courage. Code follows its rules. Its rule is to shut down when volatility is high. Therefore, in every future crisis, liquidity will vanish exactly when it is needed most. This is not an opinion. It is a logical certainty. Second, the global debt colossus. We have built an economy where growth is dependent on the continuous expansion of debt. Debt is a claim on future cash flows. The system now requires that these claims never be questioned, that they can always be rolled over, that the cost to service them never rises meaningfully. But the cost has risen. And the entities that hold this debt, pension funds, insurance companies, banks, are trapped. They cannot sell without realizing catastrophic losses. They cannot hold if rates stay high. Their only move is to use complex derivatives to hedge their risk, which only adds more gunpowder to the room. This debt overhang creates a constant, low-grade tremor in the system. It is the permanent background stress that makes any additional shock potentially fatal. Third, the illusion of central bank control. For 20 years we have lived under the spell of the Fed put, the belief that if asset prices fell too far, the central bank would step in, print money, and reverse the decline. This spell is broken. The Fed, the ECB, the BOJ. They are all in a box. They cannot print to fight inflation without destroying their currencies. They cannot ease to save the markets without reigniting inflation. They are now observers, not saviors. Their tools are blunt, and the patient is too leveraged. Their interventions will be late, poorly targeted, and ultimately ineffective in preventing the structural deleveraging that must now occur. The backstop has been removed. The markets are floating in a sea of their own leverage, without a lifeguard. So what does this mean for you? The observer, the investor, the person watching their screen with a sense of dread they cannot quite articulate. You must internalize a new reality. The market price you see for any major asset, a stock, an index, a bond, is no longer a pure reflection of value. It is a temporary equilibrium between two unstable forces, the massive, hidden leverage in the system and the anemic, algorithmic liquidity that facilitates its trading. The price is a lie, a plausible, real-time lie, but a lie nonetheless. It tells you what the last trade was, not what the next one can be. The gap between the screen price and the price at which you can actually transact in size, the so-called execution price, can be a chasm that opens in milliseconds. Your psychology is now the primary battlefield. The entire architecture of financial media, of headlines, of analyst commentary, is designed to do one thing: make you act emotionally, to sell into the void, or to buy into the mania. Their narratives are crafted to attach a simple story: the Fed, earnings, war, to a complex mechanical failure. This is because your emotional order is the liquidity the machines need to offload their risk. When you act on the story, you are providing the exit for a structural trade you cannot see. Therefore, your first and most important task is to change your frame. Stop asking, why did the market move? Start asking, how did the market move? Was it a slow, grinding sell-off on high volume? That suggests a fundamental shift in sentiment. Or was it a violent, vertical spike or drop on thin volume, like today? That is a structural break, a plumbing failure, One requires a fundamental reassessment of your thesis. The other requires you to do nothing, to stand still, to let the machine finish its spasm and reboot. The hardest trade in the world today is no trade at all. Your second task is to audit your own holdings for hidden leverage. This is not about your margin account. This is about the funds you own, the ETFs. Do you know what's inside them? Do you own a low volatility ETF that uses complex options strategies to dampen swings? You are holding leverage. Do you own a treasury bond ETF in a rising rate environment? That fund is likely using futures and swaps to track its index. You are holding leverage. Do you own a popular tech stock that is itself one of the top holdings in every major index and ETF? You are holding a concentrated, multi-layered bet on that single name's liquidity. You must understand that in a systemic seizure, these instruments will not behave as their names suggest. They will fracture. The price on your screen will deviate wildly from the net asset value of the underlying holdings. This is not a hypothetical. It happened to mortgage ETFs in 2008. It happened to bond ETFs in 2020. It will happen again. Your third task is to respect cash not as a waiting room, but as a strategic asset. Cash is optionality. In a world where liquidity is a ghost that appears and vanishes, cash is the ability to transact when the machines cannot. It is the ability to meet a margin call without being a forced seller. It is the ability to buy an asset when the algorithmic bids have all been withdrawn and the price is truly discovered by fear. This does not mean being perpetually in cash. It means having a deliberate, untouchable allocation of dry powder that exists outside of your investment thesis. It is your personal liquidity facility, your own central bank balance sheet. In the coming age of structural breaks, the return of your capital will infinitely trump the return on your capital. Today was not the end. It was a loud, screeching, undeniable announcement of a new beginning. The beginning of the end of the stable, liquid, central bank-backed market fiction we have lived in for 2 generations. The instability you felt was real. The machinery is failing. The periods of calm will grow shorter. The tremors will grow more frequent. And the final quake, the one that resets the system, will not come from a headline you can see. It will come from a ledger entry you cannot. It will come from a failure to deliver. A missed margin call in a shadow bank you've never heard of, a sovereign wealth fund unable to roll its short-term debt. It will be a purely technical event, a mechanical click, and when it happens, the narratives will flood in, desperate to explain it. They will be wrong. The only thing that will matter in that moment is your understanding of the machine itself, not the story it is told to tell, but the cold, hard, unfeeling rules by which it operates. The pattern is set. The sequence is known. Today was a rehearsal. 22.6%. In a single trading day, the Dow Jones, the heart of American finance, gone. Not over weeks, not over months. In 6.5 hours.